The banks never lose. Like,
Of
let's
course
be
not.
completely honest. The banks will never lose. They'll essentially charge you a penalty to break that mortgage change over to a variable. So the question lies is what's beneficial in the long run? Is it worth paying that penalty and then moving on to a variable and then gambling it going down or not, or are you breaking terms? Those penalties could be high.
Welcome to the Ottawa Property Podcast with your hosts Tony McNeil and Adolfo Alvarenga. Each week, they'll take a look at what's happening in the Ottawa real estate market and offer practical advice and insights for listeners. From market updates to success stories, they cover it all. Whether you're a first-time homebuyer, a seasoned investor, or just curious about the property landscape in Canada's capital, they've got you covered. Sit back, get comfortable, and let's get into it.
Let's rock and roll. Welcome back to another episode of the Ottawa Property Podcast. My name is Tony McNeil. I am a realtor based here in Ottawa, Ontario, joined always by my co-host Adolfo Alvarenga, level 2 mortgage agent with Referral Mortgages, also here in Ottawa. Each week we're going to touch on what's going on in the market, what we're seeing on our desks, and maybe some topics here and there that'll help you along if you're buying or selling or investing here in Ottawa. If you are following on the audio platforms, give us a like. Give us a share. Give us a comment. Let us know. Do you like what we're talking about? Do you hate what we're talking about? Does any of it make sense or does none of it make sense? We read them all and we respond. That being said, Adolfo, this is going to be the Adolfo Alvarenga show today.
You've been saying that for a couple of days.
I know. I'm going to sit back and just be in the passenger seat for this one.
Yeah, I made you a coffee and you already took on it.
Slammed it.
Damn, it was quick. You
It's-
should
you
have
know what?
enjoyed it right now.
I needed it. And the reason I was late today, I was at the gym and there's a Canadian Tire right next door. So I needed to get a new light for the front porch. It went out. And I was staring at this wall of light bulbs for like a good 10 minutes, man. I could not find this bulb. I had it up on my phone. I'm like, it says it's in stock. There's 17 available here. I can't find it. I'm looking. None of it makes sense. And I finally asked this girl if she could help me find it. And she scans it and finds it instantly. I felt a little silly. I thanked her and I went back and, proud. I went back and I put that sucker in. I flipped that switch on. It was blue. I was so upset.
Did she give you a blue
Oh my
light?
God, yeah.
So then did you have to go back and exchange?
I got it in the car now. I have to go back to it.
Oh, jeez.
Louisa was like, we should just leave it for Christmas. I was like, no, absolutely not. There's no way we're having a blue light.
I did it once for Halloween. We put a blue light out here for Halloween. It was kind of themed here. But because it's on the other, you can't because it's an emergency exit considered. You have to.
Oh, okay. Yeah, true.
Because it's a public area.
Yeah.
Yeah. So that's funny though.
Well, yeah, blue light. I should have read the packaging. It clearly said on it blue. Packaging was
Clearly
kind of
you were
half
asleep.
blue.
Clearly you were
I was
asleep.
feeling I was rushing, right? So now that being said, that's a good
Friday story.
good Friday story. So we do got a lot to talk about. So we'll jump right in. I don't want to waste anyone's time. We saw unemployment numbers creep up last week, and then that led to kind of the floodgates opening for this 50-point basis cut from the Bank of Canada on the 11th this week.
Yeah, Wednesday.
Walk us
big
through
week.
that.
Big week. First of all, I'm going to say that Tony wasn't right for once. He didn't trust his gut and only bet on a
So
0.25 instead of 0.50. He would have had a
I did
perfect
say
track
0.5.
record.
It's like
those
a
who don't
couple of shows
know-
ago, and I changed it like an idiot.
Tony has been calling. He had a crystal ball. He's been calling all the rate drops since June? Yeah.
Yeah, man.
Basically spot on. It's like it's as if he had the Bank of Canada on speed dial. Like
And now it's gone.
now, yeah, you didn't trust your gut.
Not a savant.
Maybe
okay.
we can start off again next year. Let's see what happens.
Start fresh
Start fresh
for
again
January
in January and
29th,
see
I
going
think
forward.
it is. Yeah.
So, 50 basis points dropped from the Bank of Canada. So, that was big. And I think it was big because of the unemployment numbers that came out right before.
Yeah.
So, that creeped up a bit. And I feel that that's what, in my opinion, caused them to do a 50 drop instead of just a 0.25. So, then now the question lies, and it's pretty interesting because I even had multiple phone calls and texts about this, is it worth breaking term and switching over
To the variable.
from
From a fixed.
a fixed to a variable?
Interesting.
So even clients that I've helped them in the time either at the beginning of this year or beginning of last year, which is just beginning their terms. So I always find it interesting, the psychological of human nature, that we always want to be winning You know?
Yeah, we can't. If someone else is doing better than us, we need to correct it and make sure that we're getting ahead too.
It's not even about somebody else. It's just I feel that it's mainly about like, okay, you don't want to have that sensation that you're losing in something.
It could be cheaper.
Exactly.
Yeah.
So I always tell the client, like, every time, and this is what you have to do. It's, yes, it could be possible, but we have to know what's your penalty to break that.
Yeah, it's going to cost money up front.
Correct. The banks never lose. Like, let's be completely honest. The banks will never lose. So they'll essentially charge you a penalty to break that mortgage change over to a variable. So the question lies is, what's beneficial in the long run? Is it worth paying that penalty and then moving on to a variable and then gambling it going down or not? Or are you breaking terms? Those penalties could be high depending on how long is your term, because that's how they base it off. Sometimes it could be, in your best case scenario, it's only 3 months of interest. So depending on your mortgage amount, that can be anywhere between $3,000 to $6,000, in terms of a penalty. But it's kind of understanding is, if we do this, what are we going to save? It's not just, let's just do it and go ahead, because you're still prepaying. So it doesn't quite make sense if your penalty is higher than what you're saving.
Yeah, why would you do it?
Why would you do it? Like, yes, there's the possibility that if rates continue to drop, you'd save more. But then you're in a hamster wheel. I would say that you're always trying to predict what's going to happen. Like, I had a conversation today with a business partner that her partner basically works for a bank.
Okay.
And I just had a conversation because I'm like thinking, I have a client who's not closed, who's closing next week, that we're currently locked at a 3-year, but there's a possibility because of policy changes that are rule changes that are happening on December 16th, which I'll touch base afterwards. And the variable being so close to fixed now, that does it make sense to go variable now, and we had this conversation, and I still have to talk to the client, but I was having this conversation with my business partner, in that sense of like, it's they work for a bank and we kind of have these relationships with them.
Mm-hmm.
And as I had the conversation, she put me on speaker and she asked her partner or her husband, what do you think is going to happen in January? Because she's like, there's for sure, she told me there's a for sure drop 0.25 happening in January. And I'm like, so if that's the case, then the variable in that moment, depending on the bank's institutions, you could get as low as 4.45. Some of them could be lower. But in this particular, we were at 509.
Okay.
499, 509. So even if that drops to 0.25, you're still at what? Like, so 4.74. And then according to what they told me in the conversation, was they're predicting that all next year will be a 1% drop, like within the year.
Okay.
Total. So then you're talking.
Sorry, can I just jump in? Are they in the industry, or are they just
industry.
Okay.
No,
Sorry,
you
said business partner. I just wanted to clear.
Yeah. So it's like I can't really state who they are.
Understood, but they
work for a bank, and then their husband or her husband works for another bank as an analyst.
Okay.
So they're kind of in the know of what's happening, right? It's not like I'm just
I was
I'm asking
not sure
a
if
complete
it was
stranger and
just
stuff.
No.
It's good to clarify.
We all have clients that are very, savvy, but not necessarily. Just because you read something online doesn't mean it's true, right? So anyway, continue.
A lot of it is bait and switch.
So they're pretty confident that.
So they're pretty confident that there's going to be a 0.25 drop come January. So supposedly what the market is estimating right now or predicting, there's a 78% of a drop of 0.25. Before the 0.50, it was at 98. So that created a discrepancy, obviously, because they're not some are saying like, okay, well, if they drop 0.50, maybe they won't drop at the beginning of the year and just see what happens with the numbers, right? But it's still high at 0.78. You're not talking like at 78%, sorry, that there will be a drop of 0.25.
This probability.
This is a probability.
Who's making up this percentages?
That's what the market is estimating.
What do you mean?
The market isn't like you know how fixed rates work based off the market stuff?
Yeah.
So that's what they're estimating. That's
Okay.
what they're kind of predicting.
So there's a
at this moment.
78% chance there'll be a 25% drop.
Exactly. That's what the market's pricing.
Or 20.25%, sorry.
Sorry, and I know it's a lot confusing.
Yeah, well, I just want to clarify the numbers, right? You just, keep everybody on track here. Me, myself is included.
No, and I know it's confusing, and a lot of times I'm just rambling on.
Okay, so do they break the mortgage or not?
No.
They didn't do it.
Well,
they're going to wait to see what January brings?
Yeah.
Okay.
And they're also going to see what their penalty would be.
What's the term left on their mortgage?
Depending on when they start. 2 years. Like for this specific client, 2 years.
2 out of 5?
2 out of 3.
Oh, okay.
So they've only been 1 year in
It's
it.
going to be pretty hefty.
Yeah, but
if the savings in the long run make more sense, I get it. But, and I want to, there's a caveat, I just said it, but to anyone listening, like you got to have that cash to do it too. It's not like you can just go in and say.
Yeah, because you're paying up front for it and then for a future gain that may possibly happen.
I mean, I get it. If I was a gambling man, which I am, roulette is my thing. We all know that. I would consider it. Like maybe even I would consider that next year. I'll be halfway through a 5-year term, but it depends on what the longevity of that gain is for me, right? I'd probably be looking at a heftier penalty because I'm halfway through a 5-year term.
If I'm honest, for myself, I don't recommend clients to break mortgages unless there's a particular reason they're doing so.
Okay.
I want either upsizing, moving.
Not just to save money is what you're saying.
Yeah. Or to pay, or because you're not, if it makes sense in the sense of like, you're definitely going to be saving way more than what you're paying for a penalty.
I mean, I'm not locked in at like 6% or something here, guys. I'm in my mortgage is 4.69, so I'm not doing too bad right now.
No, you're not. So it wouldn't be a bad thing. But again, the only times that I because the bank always makes their money most of the time in these penalties. Of course they do. So they're not losing on that. But then, yes, you could save in, but there's different factors and different options. If you have to pay unsecured debt, credit card debt, if you want to take equity out to buy, I can totally understand because there's potential and value into what you're trying to do. If it's just to go from rent rate to another, the probability of you saving in the long run is very low.
That's good to know. And I think it's important for anyone listening because I'm sure a lot of people are thinking that, man.
Well, the difference is like there are differences in terms of the rates, but the prepayment penalty they just make up their money there.
Love it.
Yeah.
Hate the banks. Love it though. That's okay. That's a very good topic. So let me kind of segue this way. So we saw the 50 basis point cut. You got people reaching out.
Yeah.
They're wondering if now is the time to break. And it's likely a little bit premature because we don't know what's going to happen in January. I mean, the way things are looking, it does look pretty probable that there will be a future cut, but I don't like you said, if it's a 0.25, like
but that's
we're kind of in
January, right?
Yeah,
so
I get that.
Back a year from now, and we're at what the primes right now is 5.45. Prime's at 4.45. That means the rates are like at 3.45. That's a big discrepancy.
Agreed. So hear me out because we were talking about this off camera. I think it's a good segue into this. If we're talking fixed versus variable right now, like what's the spread on that? Like what are you seeing in terms of like a rate that you can get variable today or a rate that you can get fixed today? Like have we bridged the gap? Are they the same? Will variable be better come January in the new year?
It could be. The gap's closer now than it was months ago.
Of course.
Just 2 months ago because there was been 2 rate drops of 0.5. That's a whole percent.
Okay, I'm going to grill you a bit. Not in a bad way.
Go.
I'm going to quiz you is a better word for it. I'm a first time home buyer. Yeah. It's a very basic, I'm buying a condo, 400 grand, whatever, right? I got 5% down. I need an insured mortgage. What is the best rate that you can probably get me if I have a very basic file, like I got high income, all the boxes are checked. There's no issues there.
One, and I'll put an asterisk to that. Best rate without having to necessarily be locked in.
I only care about the rate. That's I want the Adolfo. So I want the lowest rate possible.
You'd be okay with a clause where it says that you can't break the mortgage at any point. That
sure.
If you do, the only way to do it is for you to sell.
Let's not get too particular.
I appreciate
what you're saying. Important. I just want to know what the lowest rate is right now.
That's important because that changes the rate by like 0.10 in terms of a percentage.
Okay, fair, and I understand it translates to a lot over the course of the lifetime of the amortization. But what is that rate? Give me even if it's a 1%, even as a 0.1 spread, what does it look like?
So prime -1 or anywhere between prime minus 0.9 to prime minus 1% you could get. If you want something a little bit more necessarily tied up,
Give me the
prime is 5.45.
Let us know what it is.
So prime is 5.45. I have to give it in terms of prime because the rate is usually prime minus something.
I hear you.
Okay.
But let's say today's Friday, December 13th.
As of Friday, December 13th, 2024, prime rate's at 5.45. So if you do prime minus 1, it would be 4.45 over rate.
So let's say 4.5% for a variable rate mortgage today.
Correct.
Okay. Now let's do the fix.
It could be less than that if you want it. So now if you do fix anywhere between 4.29 for a 3-year to 4.44, give or take, approximately. Yeah. Some are higher.
Yeah.
But it just depends on the institution. But like on the lowest aspect that we've seen, let's say that.
So we're pretty much even. Basically, we're almost, like 0.25.
Almost. That's why we were just talking off camera. Like it's in 2022. It's getting back to that spread that happened in 2022, which was very minimal, right?
Thin.
So, the question lies is it time to go variable now? Are we switching off from fixed short-term fixes to variable? And this is where like we got to be careful because every time we're suggesting something, it just depends on the time of day. Like I can't, I couldn't predict that what would happen right now. I don't think anybody predicted that there was going to be that many drops right now, but. It's just we do our best based on the time that we're at. Like we can't predict that there's going to be a 0.25 drop come January. Maybe there is, maybe there isn't. But for my specific client, I still have to have this conversation with them, which is I'm going to do after this. But
call him now.
Put him on speaker. But it's like I don't think he would mind even. But it's one of those things that like they're first time home buyers because of what happened with variable the last few years. It's still somewhat of a taboo. It's still somewhat of a risk. I spoke to the assistant of a lawyer that actually closing for this file because we're trying to see if we change the amortization come Monday that the rules change.
Yeah. So
I wanted to give them a heads up to the law firm so that they don't have, because lawyers usually have the signing a few days before the closing.
Yeah.
So that way they didn't have the signing. They were supposed to have the sign. They wanted to schedule the signing for today. But if I was going to change the amortization come Monday, they would have had to sign again.
Yeah, sure.
So they would have had to do 2 signing. So that's also something that like, because I'm kind of seeing ahead of it, I was able to communicate with the people that we're working with. Like, hey, don't do double the work, But I had this conversation, and why I brought it up is I had this conversation with her, and I'm like, I might suggest them to do variable. Like, I have to at least bring it to the table because it is a possibility.
You have to do right by the client.
Exactly. And the response was very like, variable, I don't know about that. Like, they're first time home buyers. There might be a risk associated to that. And I'm like, totally. Like, it's still in people's minds as a taboo for it because of what happened. But I also feel that it's important to have a conversation for and bring it forward. And obviously that's to each their own decisions. I personally don't, if you ask me like, what I would do, I really don't know.
I think if it was me, I would want a product that allowed me to lock in. If I felt like there was anything on the horizon that looked like it was going to go up rapidly again, I'd want to be able to make that switch to a fixed rate.
So this is the thing with variable is, and I believe not a lot of people know, you're able to lock in at any point.
Yeah, exactly.
You're able to lock in at any point that your term is left. So if you start off with a 5-year variable most of the time, most common. If you've done 1 year of that, you're able to lock in for a 4 or 5 year, but you're subject to the rates at the time of locking in.
Yeah, of course, you can't get yesterday's rate.
Correct. So that's where it's like, it's still a possibility. You can go variable right now. Take a little bit of a gamble if you're per se. They drop 0.25 or they don't, and if for whatever reason they switch off and want to increase it, you can always lock in.
Of course, yeah.
The thing is, we always go to that mindset of you don't want to lose, right? So what if you were to lock in? If you were to lock in, it's higher than what you would have had it originally. So
but that's gambling, guys. This is what we're talking about, right? There's risk associated with all this. It's never gonna be. It's like buying a house. Like it's never gonna be perfect.
No,
there's always gonna be things that you have to sacrifice and compromise on.
So that's where it's important. It's to know that you're just doing right by what's the best for you in that exact moment. So it's like, and this is why, if we can get something through, is stop trying to predict what's going to happen ahead in a sense.
Yeah, live
If
in the
you
moment,
feel
guys.
that it makes sense for you to go variable right now because you understand that the market is going to drop, by all means, let's go with it. But let's not do it with the fact of like, if it doesn't go the way that you do it, that it's going to cause an upset and be like, I should have, could have, like I'll try to avoid that of it.
Right. Okay.
Because it is something to bring into the table now.
I think so. Yeah. And then that being said, you kind of hit the nail on the head there talking about this change in amortization.
Yeah.
So what is that looking like for your clients? Because you're dealing with it right now. So explain to the people listening what's going to be available to them as first-time home buyers come next week.
So as of next week, December 16th on Friday. On so the rule is changing on a Sunday, December 15th, but it's going to start getting implemented December 16th, right? So they had already announced this before. It's going to start getting implemented now. The amortization is for first-time home buyers is going to go from 25 years, which is currently at, to 30 years. So that's an extra 5 years. That one helps with qualify, which is big, right? Rates are going to be a little bit higher because of that. Like I think there's a 0.10 of a difference if you were to switch to a 30, and it depends on institutions, right? But at least the ones that we usually work with. And then the other caveat is there's a 0.20 added to the premium.
Okay.
So like let's say in your example when you said minimum down payment, when it's 5%, there's a premium to the, and this is the CMHC premium or the insurance.
This is your insurance, guys, your mortgage insurance.
That's 4%. So if you're choosing to go 30, it's 4.2.
Okay. I mean, that's not terrible.
But it's still something.
It's more money for sure.
Explain, right? And clarify. Sure. So in terms, and I did an example and we can walk through that right now. But so that's the biggest, one of the biggest. And the second biggest is that the purchase price of an insured home now is going to jump for a maximum of 1 million to 1.5.
Yeah.
So that's key because then it means that before December 15th, anything over 1 million, you need a 20%.
Yeah, I think the rough numbers on it is like if you're purchasing something for $999,000, your minimum down payment was like 78 grand or something like that. Mm-hmm. But the moment you rolled over to 1 million, you had to have 200,000. Just to kind of put some context in there for the listeners.
Yeah.
It is really interesting. I think it's going to like the detached market next year will
increase. You feel?
Yeah, I think so because I just who has. If you're getting into $1 million price point, okay, you probably have something to sell. So maybe you have the equity built up. Maybe you have the 200 grand you need to do that with. I think a lot of people don't though. What I think is going to be interesting is that because the detached market, I mean, not so much in Ottawa, but certainly in like the GTA and Vancouver and other big metros like that, is that $1 million home is going to be more like a multi-generational family now. So you're going to have like, I bet you'll see more applications on your desk for mortgages with more than 2 people on title. So you're going to see 4. You probably see a young couple with one set of parents on there. Maybe the parents are still working.
We're already seeing that.
But now it's even easier for them, is what I'm saying, right? So now they can, and they have $1.5 million. Let's say they're buying a house for $1.5 million. They have the down payment. Maybe they're first time home buyers that have the down payment. Maybe they brought money from another country. I think it's just going to be a lot easier for those people in that demographic to get in. But I do want to go back to your example because I think that's a little bit more powerful and probably a little bit more relevant to the people listening today.
Especially for right now because of something so close where rates change this week, policies changing next week. So I use the median price of the numbers that we talked about last week that I came up, which is a household, and I use it for a townhouse because it's like your starter.
Yeah, in Ottawa, that's a pretty fair starter home.
First time home buyer home, right?
Yeah.
So that's an average price or a median price. Sorry.
Yeah, we don't use average. Tony hates average. He likes median.
So what's the difference?
Don't get me started on
that. What's the difference? A quick.
Okay, just a quick one on why I don't use averages personally. If I took the average sales for townhomes in November, it would include all the outliers, like maybe there was a crazy high price for a really, really, really nice townhome that would be bumping that number up. On the inverse of that, if I take median, it takes the averages of the average. So it's a spread. So it's more like a true representation of what the market is actually worth, or your property is actually worth.
Okay. So That being said, it's 580 of a purchase price, which would be a mortgage amount of 547 plus your insurance premium, right?
Okay.
So call it, depending on what your down payment is, but 4%, like that would be 4% or 4.2, depending if you want to choose 25 or 30 year. So with and I'm just going to use this, roll this into the example, is the rate drop of 0.50 of 50 basis points that happened on Wednesday.
I'm just doing some quick math. I'm listening though.
That makes a monthly payment difference of $159.63 per month. Correct. And then on a yearly basis is $1,915. So that's the saving from just the difference of 50 basis points.
Wow. Yeah,
It's a good amount of money.
for sure.
You know?
100%.
25 bases is a little bit less, but when you add up to 50, it starts to add up, and it's like 50 in 2 months. That has been a lot. So you're talking that has been relief for clients or purchasers that were in variable for the last few years, where they just saw it go up.
Right.
So you're talking like, if we do that between 2 months, 2 times that it's happened, that's what, $320.
Yeah, it's substantial, right?
Correct.
And we're big advocates, guys, everyone listening, that it's less about the rate and the mortgage amount and more about what that monthly payment looks like.
Yeah. So then if proceeding with this example, in terms of the household income necessary to qualify for that mortgage, for that purchase, come before the rate drop, it was 140,000. After the rate drop, it was 135,000.
Right.
So a combined, and I say this again, it's a combined household income. So 2, 3, however you want to do the split, but I feel that's a healthy number, just where salaries and stuff are on average, right?
Yeah, Ottawa's, we've said it before, but Ottawa's average income in the city,
65, I believe.
household is
About 60,
household income was 128, so it's
Yeah.
about 65 a person. Yeah.
Yeah. So it's a healthy, it's starting to become a healthy number, and that where rates make sense compared to the household incomes that we're seeing, right? So just to add a caveat or an asterisk to that, if based on the new policy change that's happening in December, if the amortization were to change, the household income for the new rates, call it the 445 rates, the household income needed based on a 30-year am would be 128.
See, there you go.
So that
Sweet
is
spot right there.
actually helping. And like, yes, we're gonna run into this conversation or this sort of statement where like, oh yeah, you're paying more interest, but I also have that number, but you're also qualifying.
Yeah, just to clarify, guys, when he has more interest, he means when you bump from a 25 to a 30-year amortization, you have 5 extra years of payments, which means 5 extra years of interest
that you'd be paying. But, and this is why I ran the number for this, in terms of the interest, and I'll just say it in terms of the differences of the interest between those 2 years, those extra 5 years, the difference in interest that you're paying is about $2,000.
Yeah, it's not bad.
It's not too bad. Where it's different is what's going towards your principal. So the difference between that is 19,000.
Yeah, I mean that would upset more people than the interest, right? Because that's 19 grand you're not putting down on your mortgage.
Correct.
Your principal amount.
But why I say this is important is because it means that if your monthly, and this is key, if the two differences between the amortizations on a monthly basis is about 275, if you go from a 25, using the same numbers that we've been using, same example, it's about 275 per month.
You're saving.
That your difference in the payments. You're not necessarily saving, but it's a difference in the payments.
Understood.
So like if you were to stick with a 25 year and then switch from a 25 to a 30, the difference is 275 that you wouldn't necessarily have to cash out on a monthly basis.
Yeah, that's substantial, man.
So yes, and I feel that that's where it's important because, and I've had this conversation with you, and I think I've said this in the podcast, it's like you're in the driver's seat at the end of the day. You're deciding where those 275 a month goes towards. Like, so if I do that on a full year, that's about $3,000 a year. If I do that on 5 years, that would be 3,000, about 15K.
Yeah, so it's
so
a $4,000 difference. And
correct. So, which is as simple as just going and being like, okay, I want to make one lump sum payment towards it. And it's what it would be. Like if you decide to save that funds, because you can dictate where it goes, right? And this is what I've been telling clients of like, hey, just if you're going to extend your AM again, or let's do it just to make your monthly payments lower, especially the ones renewing from 2%, 1%.
Yeah.
And let's extend the AM again. The money that you're saving, call it, in terms, you keep your payments to what you had it, which is on average, that's what it would be. The money that you're saving, you can either decide to put it as a lump sum payment, which would eventually drop your amortization again.
Yep.
Or you repairs that's needed that come up because they come up, or family trips or anything like that credit card debts that you have to pay, things like that. So it is helpful. It's a helpful tool to save on cash liquidity that right now I feel is very important.
Yep, I agree.
So on monthly payment. So that's where it's like, that's why I brought up this number, because it's like, yes, you're paying more interest. You're paying 2,000 more in interest, but that easily would be net zero if you make these lump sum payments directly towards it. But what are you benefiting? The monthly payments less. So it doesn't mean that the bank's taking about $300 less than they would necessarily. Yeah. And you get to dictate where that goes to. You're in absolute control of it.
And I want to jump in here and give you my realtor brain is working over here. Well, just
please simplify it. I feel like I always
really
talk
important.
in a way of like, I'm assuming that sometimes people know me,
and it's hard for it's hard to articulate numbers over a podcast.
Yeah.
But I think to just to kind of give it an overview. Basically, what you're saying is that these new mortgage rules are coming into effect next week. As first-time home buyers, you can put down a 30-year amortization on a mortgage as opposed to only being able to do a 25. And that's, on an average income, an average purchase here in Ottawa, it's saving you about almost $300 a month.
Yes.
That $275, and again, you could save it in a different account, a TFSA or whatever, and you could put that down as a lump sum, and that would negate the difference in the principal that you're not paying down on the mortgage in those 5 years.
It could. It just depends. And this is where habits are important, because not everybody has the same
100%
habits and spending habits.
And right? I want to say something too.
Sure you want to touch that arm?
No, it's done now. It's going to have to live down here for the rest of the episode. The difference in the 275, even if you're not saving it, man, okay, let me say this first. If you can afford it, and you want to stay to a 25-year, that's great. Do it. If that $300 doesn't mean that much to you over the course of 5 years, a month, then stick with the 25-year AM. It's not a big deal. The people that are going to benefit from this are the ones that are on the cusp that we just talked about. The people that no longer need to qualify at $140,000 a year income, they can now qualify at $128,000 a year income, and they're getting in the market. Yeah. And I know that people on the internet, I've seen the comments on other people's stuff to say oh yeah, you're going to be paying more interest. It's not a good way to do this. I think we're forgetting here that if you're in the market, if you actually own the property, you're in good standing to gain some equity over those 5 years too, right? We're not even taking that. I was going to say that's where my realtor brain is going. What we talked about last episode was that 6.6% increase in townhome prices year over year. That was a little over $30,000, man. So we worked out we worked it out to be $3,200 a month, right? In an increase.
Yeah, $34K a year. Yeah.
So that's what I'm saying.
Compared to 2,000 that you're paying in 5 in extra interest, that's where it's
crazy,
important.
Right? We got to think long term. You say it all the time. Real estate is a long term investment, correct. And it's so true.
And it's where you have to be with the professionals that are aware of these things. Not just important in terms of a realtor as the sale or the mortgage and just to put you on a mortgage. This is why I always say long term goals are so important, and it's such a long term investment. You're not buying a T-shirt that you can replace in a year from now. You're not a pair of shoes. It's the long-term aspect of it. And it's monetarily, how does it make sense for you in this moment that we can get you in, like you said, at a lower qualifying income, household income, so that you can get in. So this is, and I'm just going to add to it because I think you didn't state this, is what if the prices start to skyrocket come the spring market again?
Yeah.
Because we don't know what's going to happen. And I don't want to say it as this is what's going to happen, because I'm not trying to incentivize it.
Yeah,
right?
I hear you.
But I'm just saying, what if? So if we go to the what ifs and everything, okay, you're paying more interest. What if you pay more interest? Okay, if the rates continue to increase, you pay more interest. If it drops, you pay less interest. what if the market starts to spike up again?
Yeah.
And we see COVID numbers, or maybe we won't get to that point, but what if it starts to pick up again? The household or median price of a townhome is not going to be 580 at that point. It might jump back again to what?
Yeah, it could be in the low sixes, mid sixes. And then I think to loop it back to what you're saying is that now that $128,000 annual income to qualify for this
It's higher.
is higher.
And the down payment is needed is more.
Exactly.
Because
So
your prices are up.
You're always going to be outpaced by this market.
Correct.
Because that's just the way, it's the nature of the beast. It is what it is. And we can sit here and anyone listening could say like, oh yes, pumping up the market, it is what it is. But it's so true. Like if you have the chance, the window gets smaller every day, you don't do it.
Yeah. And it's important to know that we're not trying to say like, hey, go out and buy. It's, if it makes sense for you.
Yeah. Have a conversation
about
about
it. You are thinking of, have a conversation.
Yeah.
Think of it. Just don't start seeing what the news article says, what you see in the TV. Have the conversation with the professionals that are able to assist you through it.
100%.
And it's like professionals that are very submerged into it, that have had experience of not just one market where it's like either COVID market or a market that's not so, but a market that's they've been in the industry for a good amount of time, that they've seen a lot of things and they can fluctuate and change as things change, right? So that's where I think it's important, and it's knowing how to assist not just in what you're doing, so not just on the real estate aspect or not just on the mortgage aspect, but as a full. And I'm just going to tie this into this, which is important because as we get closer to the end of the year, there is I think we've touched about this, but I'm going to state it again. First time home savings, first time home buyers account, FHSBA or BA, whatever. So I had a conversation with a friend yesterday that he's somewhat of an investor planner for doctors, and he told me, he's like, it's that so many of them are confused with that account, first time home savings.
Okay.
Because it's okay. So, and I'll ask you this question, and I have to put you on the spot now. Is the limit's $8,000 a year, right?
Yeah.
But if it's $8,000 a year, what if you are not capable to put the full $8,000 that year? What happens?
It rolls over to the next year, right?
The difference.
Yeah.
Okay. Up to?
Oh, well, the savings account is 40 grand, so I don't know.
To the total of that, right? So then it's like every year it's 8,000. Whatever you don't be able to put on, it rolls over into the next year. So, but if you don't open that account.
Yeah, you can't roll over. It doesn't exist.
Exactly. So this is why I'm saying it's towards the end of the year. I've had a few potential buyers that are interested in terms of a pre-approval, and one of the first things I asked them, like before the conversation ends, like, do you have a first-time home buyers account? They're like, no, we haven't opened it. I'm like, run to your bank, open an account. Like that's the first. Just open it, even if you don't put anything in it, just open it.
Yeah,
because then it's like you have that capacity to put into it. How is this beneficial? Obviously, it's an income tax deduction towards your income, and then it's also whatever you don't put on, it rolls over. So if you are aiming to buy a home, it's one of the probably best tools out there to do so, which is, I could say, one of the good things the government has done.
Yeah, really important for any young people listening and parents. I think, what is it, 16 is the minimum age, or 18?
I don't know.
It's one or the other, 16 or 18. So if you have kids that are getting to be that age, like as soon as, like maybe they're not planning to buy until they're in their mid-20s, but open that account like the first day they can.
We have to fact check that if they're able to open the account when they're underage.
No, I know that there's, it's either like when you turn 18 you can open it, or when you turn 16 you can open it. I just don't know which one it is. I'm saying that the moment that they turn one of those ages, they should open that account.
Yeah, totally. And even if you don't contribute to it, because it's like, it's as easy as like putting, I need to gauge, and this is why I'm saying I need to fact check this, because I want to make sure that it's like $8,000 every year that it rolls over into.
Yeah, that'd be a good question.
Because is there a max of how much? Because what it means, I open it at 18,
and they can drop 40 grand.
40 grand at the end of the year, and then it's like you're
at the end of the end of.
So that's where it's like and that's why I understand it's confusing, because I was like, oh, what's so confusing about this? You put $8,000, you put it $8,000 each year, and it's like simple as $8,000, but then not everybody has that capacity to put $8,000 every year. So then the question is, okay, what rolls over? And is it every year that rolls over?
We should check that for next episode.
Yeah, and just to confirm it. But I think, like I said, like it's important to open that account ASAP if it's something that you're thinking of. doing it in the next few years.
Agreed. Well, I think that was a lot of information, my friend.
I think it was a lot, and I think I felt that did a lot of the talking. I need water.
It's okay. You did fantastic. I said it was going to be the Adolfo show today.
All the time. Damn.
It's okay. No one's watching. No, that being said, I think that's a good place to end it for now, because I know it's a lot of information for people to take in. That was really great. I love that breakdown of the average income, average townhome. Like these are all really practical scenarios and practical case studies that apply to a lot of people in the city. So if you have a lot of questions, if you have one question, two questions, reach out to us, guys. This is what we do every day. We love talking about this. And we love helping people. Yeah, like I said, if you're following on the audio platforms, drop us a like. And I want to say that next week will be our last episode of the season.
Okay.
I think so.
We're going for the Christmas holidays. Okay.
Well, yeah, we should take a break for the Christmas holidays.
We have a lot. Tony needs to cook his
Jig's dinner.
Jig's dinner. Yeah, there we go.
Well, also you have to help me build that built-in for me. So we got a lot of work to do. I think we'll resume. Yeah, but I wanted to say that next week we'll have our predictions for 2025.
Okay.
So
you didn't want to wait till the new year to start?
No. Predictions should happen before the rollover.
Okay, fair. I'm just saying, because like it's not like the announcement is the first week of the year.
Listen, I'm shutting off my phone from the 23rd to the 31st or 2nd or whatever. So like I just can't think real estate over that week. We all need a break, and I think it'd be a good way to end it. And then that can be our tradition every year, that we look at this episode to say, like, were we right? Were we wrong? I don't know.
Yeah, that's fair. That's good. I mean, you were right most of the time. So,
well, we're not just talking about rates, but I want to talk about like predictions for home prices, what's going to happen with the market, that type of thing. So, if anyone's listening and has any, prediction ideas, drop us a comment, because we'll make some predictions about this, some outlandish predictions.
Let's do this.
Yeah, and as always, guys, thank you for tuning in, and we'll see you next week.
I'll see you guys next week. Ciao. Cheers.
Nothing to it, man.